In this session, I'm going to look at two important roles of a central bank of any country. So, on one side, they go with liquidity regulations, and on the other side, they act as lender of last resort. So, they look very contradicting, right? If one is there, what is the need for the other? So, this is what is the context of this article. Why do we really need both of them? So that's where we are looking at where is this a lender of last resort is better, in what kind of scenarios I see a central bank acting as a lender of last resort is much effective compared to using liquidity regulations, and where is it otherwise. In what kind of scenarios liquidity regulations are really effective in managing the liquidity and systemic risk. So we are looking at few aspects here: the lendings of the central bank versus the liquidity buffer exhaustion process, lending in response to the troubles at different individual institutions. What is that the central bank is doing, especially when an individual institution like a Lehman Brothers failing or Bear Stearns failing? What is the typical response for individual institutions? What are the challenges and constraints to a central bank if it has to act as a lender of the last resort? What are the various limitations with respect to the central bank? And finally, we are going to look at what is the optimal policy mix to reduce the systemic risk, especially when the economy is completely down. The global financial markets are facing tough scenarios. So what is the kind of an optimal policy mix to manage the systemic risk in all these situations? Now, looking at the role of a lender of last resort. So after some kind of problem has occurred, after some liquidity crisis has come out, the central bank is actually getting into the lending process. So the solvent bank experiences more liquidity problems. Some bank which is otherwise solvent, primarily because of market-wise stress, right? Not because of the individual bank problems. The whole economy got badly affected. The whole market got really troubled. So because of that, otherwise solvent bank experiencing the liquidity problems. So which means the factors are more and more exogenous, not specific to one single firm, not because of the operations of that one single firm. That is where the lender of last resort comes in more and more handy. So here we are talking about the liquidity demands, the liquidity problem coming purely because of the broad problems, not company specific situation, right? So there is a runoff on the banks, and in regular scenarios the bank was pretty much fine, but on solvent institution there is a runoff that has occurred because of some external factor, and the deterioration in the markets has gradually there was a heavy deterioration in the markets, and that's where the lender of the last resort can come in more handy. So the interbank market is also unable to meet the demands, aggregate shortfall in the availability of the reserves, and because of that the interbank market is unable to meet the needs, and especially during the stress periods the problem gets even more serious. So in this kind of a market, liquidity is drying up. Especially one more thing which we have observed during the crisis was banks refuse to get into an interbank lending process. They lose the confidence. Can we get our money back? Can the borrower is the borrower comfortable enough to pay back during the specified period? So interbank borrowing gradually reduce, And that is also one more reason why the liquidity problems come up. So in these kind of scenarios, central bank can very much provide the liquidity to those institutions at a minimal cost. They are not problematic institutions, but because the overall economic scenario has worsened, these banks and financial institutions started facing liquidity issues. So it's not a moral hazard here, right? We should not look at these kind of problems as moral hazards, because it is the liquidity has got dried up because of an exogenous scenario, not because of the firm specific activities. There was an entire market wise stress, and that is what has really created the liquidity problem for the bank. And in this case, if let's say there has been a liquidity regulation rather than lending as a last resort, then probably more and more heavy capital requirement would actually make the bank not optimal in terms of functionality. So less than socially optimal liquidity, and that could be a kind of an unnecessary burden and the cost on the bank. So in this case, especially in short, when there is a market-wise stress and a firm is typically becoming more and more illiquid because of the broader economic based scenarios, but not the company specific circumstances, in that case, the central bank lending is a better solution. So it prevents self-reinforcing liquidity spirals. The defaults will not be costly, and contraction of the credit to the real economy, the impact will be gradually reduced. Whereas on the other side, when should a liquidity regulations be put up? Liquidity regulation is before the crisis actually occurs, and especially when the solvency of the institution becomes questionable. So it's not a systemic problem, it's one specific institution's activities that are going viral and they are impacting the overall financial system. So the liquidity needs are primarily of that particular individual institution. So the whole thing is a question about the solvency of that single institution, but having a chain reaction, but it has nothing to do with the overall economic scenario. So we have to really differentiate between illiquidity and insolvency, where the line of difference is much thinner, and the central bank has to really put a lot of effort in terms of really distinguishing what both these things are. So in case of a crisis, LOLR, lender in the last resort, it has more credit risk than it would be in the normal time. In case of a crisis, if it is acting as a lender as a last resort, of course it is taking more and more credit risk than in the normal time. And if you look at LOLR lending, there is a possibility of a moral cost hazard in this kind of a scenario, because the bank will not have any kind of an incentive to really monitor its situation much effective. It knows that, yeah, even if we fail, the central bank acts as a lender of the last resort. So there is an involvement of the credit risk associated with the bank, not just the general market liquidity risk that is existing here. And central bank cannot generally price or eliminate this risk. In these cases, the liquidity regulations are much more effective rather than acting as a lender of last resort. Right? So even the financial institutions, they would not be bothered about taking more risk. They'll go about taking more and more risk because they know if something is not going in their favor, obviously central bank will come and rescue them. So even if their solvency situation is deteriorating, there is an option of approaching the central bank to act as a lender of the last resort. So that is a very dangerous problem. So in those cases, like acting as a lender of the last resort is never a good solution. So this entire scenario can be mitigated by conservatively pricing the collateral, not going for an aggressive pricing. Risk to the other short-term creditors typically goes up because if I am pricing the collateral much conservatively, more and more collateral has to be collected. More collateral means other short-term creditors would not be paid because a lot of amount is being kept as a collateral. Then that could have even more a ripple effect or a cyclical effect across the overall financial system. Look at the central bank lending versus the liquidity buffer exhaustion. Right, if you read through this stuff, you could see that the financial crisis was primarily breakdown of various funding markets. So there is an interbank funding market that got completely frozen. We have seen in various earlier sessions that there was trouble with respect to the commercial paper market, which was perceived to be very liquid. There were problems in terms of valuing structural financial products. All these have typically experienced very heavy liquidity shocks. So extending credit to each other the interbank lending and borrowing almost got frozen out because they were all fearing, if we lend it now, will we get them back? Because of this, the term interbank interest rates, they really rose sharply during that period. One of the things, the whole buffer got completely exhausted. And look at the primary credit facility. Federal Reserve has really reduced the spread between the primary credit rate and the target federal funds rate. It has been reducing first 100 basis points, then 50, then 25. So there was a big decrease as a lender of the last resort. The central bank has been intervening at regular intervals of time, reducing the gap between the primary credit rate and the federal funds rate. Even the maximum term of these loans, initially it was just 30 days, overnight became 30 days, then 90 days. So central bank has really come forward in terms of extending the buffer. Then there was a term auction facility. So there is an auctioned discount window credit to institutions that has access to the primary credit facility. And the rate on these loans was really arrived at using an auction process, and the funds were made available a few days after the auction is closed. So this is one more way in which the access to the funds of a frozen institution has typically come out. Auction determined interest rates were very close to the market rates, and these kind of loans were only available to the banks whose financial condition was good enough, but because of this exogenous situation of the overall market deterioration, they are facing the liquidity problem. So the Federal Reserve was relatively confident that some of these banks are very healthy. Only the short-term problem has really caused the liquidity problems for them. So the Federal Reserve wanted the borrower to pledge collateral in excess of the loan amount. So it's like it has put a lot of haircut, and based on that, more and more collateral needs to be deposited over and above the loan that has been taken. So for different types of collaterals, again they have come out with different amounts of haircuts, but that's one more way the central bank has really approached to address the liquidity problem. Now, with respect to the individual institutions like Bear Stearns or AIG or any of these institutions where there was a trouble at individual institutions, it has even got into the process of providing the loans to them to really keep them from defaulting. That's one major problem. They have the central bank has actually facilitated the process of acquisition of Bear Stearns by JP Morgan. Right, we all know that the firm has actually experienced a run on the bank, depletion of the liquid assets, and it was not even able to meet the current obligations at that particular point in time. So it was not able to repay its repos and other obligations even the next day. And this is where we see at that point in time Federal Reserve has actually lent close to $13 billion against $13.8 billion in collateral So this much of lending has been done to Bear Stearns for a revival. Similarly, there was a kind of a scenario where AIG, which was again a troubled institution, the central bank came forward to provide loan to AIG as well. We all know there were a lot of concerns regarding the solvency, liquidity of that particular institution. And because of that, a fire sale of the asset and bankruptcy all were possible. And at that point in time, the central bank has actually given a credit up to 85 billion to the AIG so that all the obligations can be met. And the term of the credit was even extended. It was pretty costly and it had a lot of constraints on the firm's owners, managers, creditors, etc. The risks that were taken were, in these two examples, if you look at, the risk that was taken by the Fed was much, much higher than the risks in the broad-based lending. Even the whole financial situation would have been worse. One or two institutions for which it would have lent because of the overall market problems, that risk would have been much lesser compared to the risk that it has gotten through this kind of a lending process. Majority of the loans were non-recourse, so they are purely based on the cash flows of the cash flows generated by the underlying project. So the Fed completely looked at the value of the collateral only to protect itself. So look like some of the challenges that came out, right? They took some wrong decisions during that process, and Federal Reserve was unable to provide a loan support to Lehman Brothers there. The only tool that was available was provide short-term liquidity against adequate collateral, but even the collateral was not adequate from the Lehman Brothers point of view. And substantial capital was required from Lehman, and even an open-ended guarantee of its obligations to continue operating. Neither the Federal Reserve nor any other agency had authority to provide that kind of an unsecured guarantee. So there was no way they could really back out, provide some kind of a support to Lehman Brothers. And taking too much of collateral might increase the likelihood of error. Because we see during the crisis, we see a lot of investors, they backed out. Various institutions, products, they really pulled out their investments from all of them because they found they are very, very risky and they are not willing to bear that much of a risk. And if the Fed has really protected itself when providing those loans, it would have increased the risk that is typically carried by the remaining private investors. So that was one of the major challenge and constraint that has come to the central bank, acting in the role of lender of last resort. So finally, to conclude, this is what looks like an optimal policy mix to address the systemic risk. So there should be central bank lending which is more aggressive, but along with that the liquidity and other regulations also need to be more and more robust, which means they both are necessary and they need to complement each other. Liquidity regulations wise, they really penalize the liquidity risk. So they make the banks hold a big buffer, and at the same time low yielding assets hold a buffer of liquid but low yielding assets, but along with that mitigate externalities associated with the liquidity trouble. So because of this, the banks get completely discouraged from carrying the liabilities which have the highest liquidity risk, and the banks that are having good amount of liquid assets, they feel more and more comfortable. They have less capital requirement. They are ensuring that almost all their margin calls are getting met, funding withdrawals are getting met, so their liquidity risk is much lesser. They really don't need to get into the fire selling of their assets. And it also ensures that the central bank and all the supervisory authorities, they have the necessary time between when a problem is detected and when a default may occur. Right? More and more regulations in place, I can very well see, okay, the moment the problem is detected, today itself it will not end up into a default. So this is where the new liquidity coverage ratio, which is talking about the 30 days of severe risk, that much of high quality liquid assets need to be maintained by the bank to meet the net cash outflow of the next 30 days under the severe stress condition. So that much of capital that is maintained by the bank is very much sufficient to address the gap right from the problem detection to the default kind of a scenario. Right? As long as the high quality liquid assets are quickly valued, it can be a kind of a protection altogether. And taking the role of lending in the last resort, especially during systemic shocks, overall financial system getting badly damaged, will really put some kind of confidence, reduce the pressure to really bring up the liquidity, broke the break the pro-cyclicality of the liquidity crisis. This is something that is going to happen at some at an interval, some periodic interval. So in that case, there will be some kind of support that comes from the central bank. So a combination of these two things definitely is a good solution to manage the systemic risk during the financial downturns. So that's what is this article all about. Why we should need both these two contradictory and these two scenarios which actually act in extreme scenarios. In reality, they are not extreme. They are going to complement each other, and central bank really needs to have a mix of these two things to really reduce the systemic risk in terms of financial distress. If you have any further queries regarding this session, please get back to me by giving me a call on the number that I have given below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.